thought for a channel like this, it's important to cover the basics. And I think the first thing that we should talk about is the most important financial document. Well, firstly, a balance sheet is a snapshot of a company's financial strength at a specific date. It's very important to know that it's at a specific date, not of a time, which is why you see as of December 31st, 2020, for example. And it does this by showing the company's assets and liabilities and how they balance off each other. Assets are what you own that could benefit you in terms of making money in the future. So, for example, cash. If you already have cash, you can use cash to buy the products in which you can sell for a profit. So it helps you make money. Land, if you own land, you can actually put a factory there to make stuff and make money. Inventory, which is like your product, your merchandise, is your asset. Whatever is worth is what is called your asset. And then the fact that you can sell it to make money is what makes it an asset. But what is very important is that you own it. If you don't own it, it's not your asset. Liabilities are what the company owns. So just think of it of a company's credit card debt. It's loan, leases to suppliers and banks. So it's very, very important that companies know exactly what they owe to know exactly what to do in the future and how to operate. And whatever is left is usually called stockholders' equity. So that's the difference between the assets and liabilities, which in theory is what the company is actually worth. If the company has $100 million in assets but owes people $50 million, then it's worth $50 million because that's what it has left. So it's like everybody else. If you have $10 and you owe somebody $5, you are worth $5. So the stockholders' equity is very, very important because it actually shows what is left after it pays everybody, in theory. Alright, so I hope I've explained what a balance sheet is, at least to a good point. However, there is limitations to the balance sheet. It doesn't tell us the business model, so it doesn't tell us how it makes money, and it doesn't tell us how it intends to grow, and it also doesn't tell us who the customers are. So it does have its limitations, but it's a good starting point to at least know how safe the business is, at least when it comes to paying debt. Because debt could be a bad situation as it continues to grow, because it'll take your eye off the ball when it comes to growing the business, and it also means you owe a lot of money to somebody else. So it's going to be a big problem when those debts come calling due and you don't have enough money. So it doesn't tell us everything, but it does tell us how safe you are. So now, as an investor, it does tell me that there's space to grow and there's room to grow if you don't have to worry about debt all the time. So like and subscribe, guys. The sets are going to improve. First video. I hope you guys like it. I hope I explained it well. Smash the like button, subscribe, do whatever. It helps the video. Thanks.